I have a question for you. What's the one thing you buy that is relatively expensive, that you have to renew constantly, and yet, if everything goes perfectly according to plan, you never, ever get to use it?
That is the classic riddle. And the answer, inevitably, is insurance.
Yes.
It is the ultimate grudge purchase.
Yeah.
You pay for it, hoping it's a total waste of money.
Exactly. It's the industry of just in case. And look, I'll be honest with you, and I think I speak for a lot of people here. When most folks hear the word insurance, their eyes kind of glaze over. They picture stacks of paperwork, confusing fine print, and that one agent who keeps calling them during dinner. It feels like a chore, right? Something you have to have, but hate thinking about.
It's definitely the industry with the biggest gap between how boring people think it is and how incredibly vital it actually is. It's the invisible architecture of the economy.
The invisible architecture.
Without it, everything just stops.
And that is exactly why we're here today. We are going to flip that boring narrative on its head. We've got a stack of documents here that make up the Diploma in Insurance Services curriculum from the National Institute of Open Schooling, or NIOS.
Right.
And before you tune out thinking this is just for students, this material is actually a goldmine for understanding how the modern world works.
It really is. I mean, we aren't just looking at how to fill out forms here. We're looking at the engine that keeps the economy from collapsing under the weight of disaster.
The engine of risk. I like that. So what's our mission for this deep dive?
Our mission is to take apart that engine. We want to understand the mathematical philosophy behind risk, the strict, and I mean strict legal code that makes it all work, and the massive career shifts happening right now with the rise of AI.
And this curriculum, it was developed against a pretty interesting backdrop, wasn't it? The Skill India mission.
That's right, the Skill India mission.
That launched back in July 2015, correct?
Correct, July 15, 2015, to be precise. The government identified the banking, financial services, and insurance sector, the BFSI sector, as a massive driver for employment.
Okay.
They realized that if Make in India was going to work, if we were going to build all these factories and all this infrastructure, you needed a safety net for those new businesses.
And that safety net is insurance.
A safety net is insurance.
So whether you're a student looking for a career or just someone wondering why your car insurance premium went up, this deep dive is going to change how you see those monthly payments. It turns risk from a scary abstract concept into, what, a manageable math problem?
Precisely. It's about quantifying the unknown.
So let's get into the mechanics. The source material starts with some definitions that seem simple on the surface, but are actually really specific. It distinguishes between an asset, a risk, and a peril.
Yes.
Now, in normal conversation, I'd use those interchangeably. I'd say that fire is a risk to my house.
And in a casual conversation, that's fine. But in this industry, precision is everything. The NIOS text breaks it down like this. An asset is the thing of value.
Okay, that's the easy part. My car, my house.
Or your life, your eyes, your business's reputation. If it has value, it's an asset. Now, peril and risk are where people get tripped up.
Right.
The peril is the specific event that causes the loss. Fire is a peril. Flood is a peril. Theft is a peril.
Okay, so the fire isn't the risk.
No. In insurance terms, risk is the chance of loss. It is the probability. It's the likelihood that the peril will actually strike the asset.
I see. So if I live next to a fireworks factory, my peril is an explosion, but my risk is incredibly high compared to someone living in a concrete bunker.
Exactly.
Right.
And insurance is the mechanism to manage that specific probability. The text uses this really fantastic analogy to explain how this all works. It's the village analogy.
I love this part. It makes the math so visual. Walk us through it.
So imagine a village with, say, 1,000 houses. And to keep the math simple, every single house is valued at exactly 1,000 rupees.
Okay, 1,000 houses, all worth the same.
Now, historically or statistically, we know that in any given year, maybe 5 of those houses will burn down.
Okay, so we have the stats. 5 out of 1,000 houses are doomed. The problem is nobody knows which 5.
That is the uncertainty. That is the risk. So imagine you're one of the homeowners. You're living with this constant anxiety. If you're one of the unlucky 5, you lose 1,000 rupees. For most people, that's a devastating, life-ruining loss.
You're at 0.
You're at 0.
But the other 995 people, they lose nothing.
It's basically a terrible lottery where you really, really don't want your number called.
Correct. So the village decides to solve this mathematically. They pool the risk. They say, look, the total loss for the entire village is going to be 5,000 rupees.
Right. 5 houses times 100,000.
Exactly. So if we take that 5,000 loss and spread it across all 1,000 homeowners, everyone only has to pay 500 rupees.
That's the premium.
That is the premium. By paying 500 rupees, you guarantee that even if your house burns down, you get the full 1,000 back. That is such a clear way to put it. Instead of 5 people being completely ruined, 1,000 people pay a tiny, manageable amount.
And the source defines it beautifully. Insurance is a process where the losses of the unfortunate few are shared by the exposed many.
The exposed many. That phrasing really stuck with me. It reframes the whole idea of wasting money on insurance. Even if I don't make a claim, my premium wasn't wasted.
No,
It did its job. It was the price of admission to the safety net.
exactly. And that leads to another concept in the material that I think is profound, even outside of finance: the burden of risk.
Yes. This felt more psychological than financial. The text talks about primary and secondary burdens.
It does. It deals with the mental cost of living in a dangerous world. The primary burden is the obvious one, the actual physical loss. The factory burns down, the car is stolen, the direct damage.
That's the event itself, the wreckage.
Right. But the secondary burden is what you carry every single day before anything happens. It's the stress. It's the anxiety. It's that physical strain of worrying about what if.
Oh, I feel that. It's that background radiation of worry. Did I lock the door? Is the stove off?
And financially, that secondary burden has a real cost. The text explains that without insurance, you'd have to keep massive liquid reserves. If you didn't have fire insurance, you'd have to keep a pile of cash in the bank big enough to rebuild your house at a moment's notice.
And that money is just sitting there. It's not doing anything.
Exactly. It's dead money.
Yeah.
It's not being invested in stocks. It's not growing your business. It's not being used to buy new equipment. It's paralyzed by fear.
That is a huge insight. So insurance doesn't just pay for the burnt house, it liberates your capital. It removes the secondary burden so you can actually take other risks, like starting a business.
Precisely. It allows for economic efficiency. It greases the gears of the whole system so people can innovate without looking over their shoulder constantly.
Okay, so we've established that insurance handles risk and frees up our minds. But here is where I always get tripped up, and I think a lot of listeners do too. If risk is just uncertainty, why can't I buy insurance on my stock market trades? Or why can't I insure a bet I made on a cricket match? That's risky.
That is a very common question. And honestly, if you could insure stock trades, nobody would ever work again.
Yeah.
The curriculum addresses this by distinguishing between pure risk and speculative risk.
Break that down, pure versus speculative.
Pure risk is a situation where there are only two possibilities: loss or no loss.
Yeah.
There is absolutely no upside.
Give me an example.
Your car. It either sits in your driveway safe and sound,
No loss.
or it gets stolen. Loss. You don't wake up one morning to find your Honda has magically turned into a Ferrari.
Sadly, no.
That is pure risk. And generally, pure risk is insurable. Fire, theft, death. These are pure risks. Now, compare that to speculative risk. This is where you have a chance of loss, a chance of breaking even, but also a chance of profit.
Like buying shares in a startup.
Exactly. Or launching a new product line. You are voluntarily entering that situation because you want to make money. The source material is very clear. Speculative risks are generally uninsurable.
Because if they were,
It would create what economists call a moral hazard. If insurance covered your bad stock picks, you would take the wildest, stupidest risks imaginable.
because there's no downside.
Zero downside. You'd bet the house on a coin toss.
That makes total sense. Insurance is a shield, not a lottery ticket.
Correct. The text also mentions fundamental and particular risk, which I think is very relevant.
Right. Yeah.
Particular risk is individual, like that specific house fire in our village. But fundamental risk is something that hits a huge chunk of society all at once.
We're talking tsunamis, earthquakes, a major war.
Exactly. Or an economic depression. The source mentions that these often require government intervention because the scale is simply too big for a private insurance pool.
Right. Going back to our village, if an earthquake destroys all 1,000 houses, that pool of 500 rupees from each person isn't going to cover it.
Not even close. The math breaks completely.
Okay, let's shift gears. We've got the math of the village, and we've got the types of risk, but none of this works without a contract. And looking at the material, the legal side of this is surprisingly intense.
It is. An insurance policy is a contract. And like any contract in India, it falls under the Indian Contract Act of 1872, so it needs the basics. Offer and acceptance, consideration, which is the premium.
Standard legal stuff.
Capacity, you have to be an adult of sound mind and free consent. But then the source introduces this Latin phrase that sounds like a Harry Potter spell: Uberima Fides.
Say that again?
Uberima Fide. It translates to utmost good faith. And this is probably the most critical legal concept for our listeners to understand. It is the absolute bedrock of insurance.
Okay, so how is that different from normal business? If I buy a used car, the principle is caveat emptor buyer beware. It's my job to check the engine.
Right. In normal commerce, the seller doesn't have to list every single scratch unless you ask.
Mm-hmm.
They can stay silent. But insurance is the polar opposite. In insurance, the company is relying entirely on the information you provide. They can't check your heart condition or your family history directly in that moment. They are betting on your word. So the law shifts the burden to you.
Okay.
You have a positive duty to voluntarily disclose all material facts.
Voluntarily is the scary word there.
It is. The text gives a great example. If you are buying health insurance and you have a pre-existing heart condition or you're a smoker, you must disclose it. Even if they don't ask you specifically, are you a smoker, you have to say it.
So if I stay silent, pay my premiums for 10 years, and then try to make a claim.
The contract can be voided. The source says explicitly. Silence can be fraud here. It's not just about not lying. It's about actively telling the whole truth.
That is a heavy responsibility. You can't game the system by omission.
You cannot. Because if you do, you break that chain of utmost good faith, and the safety net just dissolves.
The other legal principle that really stuck out to me, and this answers a dark hypothetical I had, was insurable interest.
Right. This prevents the murder-for-hire scenarios you see in movies.
Basically, can I take out a life insurance policy on my neighbor just because he drives like a maniac and I think he's going to crash soon?
No, absolutely not. The principle of insurable interest says you can only insure something if you stand to lose financially if it's damaged or lost.
So I need to have skin in the game regarding their safety, not their destruction.
Exactly. If your neighbor dies, it's sad, but it doesn't cost you money. Therefore, you have no insurable interest. If you were allowed to insure him, it would become a wagering agreement.
Which is just a fancy legal word for gambling.
And illegal gambling at that. The law wants to prevent a situation where you might actually want the loss to happen.
That's logical. You
Yeah.
shouldn't profit from a disaster. You should only be compensated for it. Now, there's a tricky nuance in the text about when you need this interest. This seemed like a potential exam question trap.
Oh, it definitely is. It's a crucial detail. For life insurance, you need to prove insurable interest at the time you buy the policy.
Okay, at the start.
But for general insurance, like your factory or car, you need the interest at the time of the policy A&D at the time of the loss.
Wait, explain that. Give me an example.
Okay, suppose you sell your car to me today. Tomorrow I crash the car. Can you claim the insurance you paid for?
Well, I mean, I paid the premium for the year.
Doesn't matter. At the
Yeah.
moment of the crash, you didn't own the car. You suffered no financial loss. You had no insurable interest at the time of loss.
So no payout for me.
No payout for you.
That is fascinating. So the insurance is tied to your relationship with the asset, not just the asset itself.
Precisely.
This legal backbone is really what separates insurance from just a casual bet. But I want to zoom out a bit. The NIOS curriculum isn't stuck in 1872. It has a whole section on digitalization in insurance.
It does.
And it makes it clear that the image of the guy with a briefcase full of papers is becoming history.
Absolutely. The industry is undergoing a massive transformation. The source highlights how tech is changing the entire value chain from pre-sale to post-sale.
One thing mentioned specifically is the use of AI and chatbots.
Yes, and this isn't just about cutting costs. The text notes that AI-enabled chatbots are now automating product sales, handling queries 24/7. It used to be you had to wait for office hours. Now it's instant.
It's interesting how that changes the relationship. You're interacting with an algorithm. And the source mentions social networks, too.
Right. Insurers are using social platforms not just to advertise, but to connect with customers, even to gauge risk in some cases. It's becoming a much more connected, digital-first experience.
This brings us back to the Skill India mission. If everything's going digital, what does that mean for humans? Is the robot coming for the insurance agent's job?
It's a valid fear, but the curriculum paints a different picture. It's not about replacing the human, it's changing the role. But more importantly, it emphasizes the huge variety of careers beyond just agent.
I was actually surprised by the list in the source text. It's really diverse. It's not just finance people.
It really isn't. For example, they mention surveyors and loss assessors. These aren't just paper pushers. The source says these are often independent professionals from fields like engineering or medicine.
Wait, doctors?
Yes. Think about it. If there's a complex medical claim, a banker can't evaluate that. You need a doctor. If a bridge collapses, You need a civil engineer to survey the damage.
That is really cool. I never thought about an engineer working in insurance. It's like being a forensic scientist for buildings.
Exactly. Then you have actuaries, the math wizards who calculate the probabilities for our village. You have claim investigators who look into fraud. Basically, insurance detectives,
Like in the movies.
sometimes. And third-party administrators, or TPAs, who manage health services. The point the curriculum makes is that as the sector grows, it needs a diverse workforce. Tech people, math people, medical people, legal people.
So if you're listening and you're good at math or engineering or even just investigating things, there's a lane for you here.
Absolutely. It's a major growth sector.
Okay, let's unpack what we've covered, because we've traveled quite a distance from insurance is boring.
We have. We started with the engine, the pooling of risk. We saw that insurance is actually a community safety net.
Right. The exposed many protect the unfortunate few. And we clarified it's not gambling, it deals with pure risk, not speculative risk.
And we looked at the legal backbone Uberima Fides. Utmost good faith, trust is the currency.
And you have to have insurable interest. You can't just insure a stranger.
Exactly. And finally, we saw it's a high-tech field now with a huge range of careers. It all connects back to that skill India mission. The economy needs this engine, and it needs skilled people to run it.
So before we wrap up the so what question, why should the listener who's just a regular policyholder care about this stuff?
Well, practically means the next time you fill out a form, don't skim it. That minor detail you leave out could void your protection when you need it most.
Yeah.
Honesty is literally the best policy.
And on a deeper level,
On a deeper level, understanding this helps you manage your own life. Insurance reduces that secondary burden of anxiety. It frees you up to take calculated risks, to switch jobs, to open that bakery, because you know your basics are covered.
it's freedom from fear.
It is. But I want to leave the listener with one final provocation, something to think about from the chapter on risk management.
Just hear it.
We spent this whole time talking about risk transfer, paying someone else to take your risk. But the source material also lists risk avoidance and risk reduction as strategies.
Okay, so what does that look like?
It means asking yourself, what risks in your life are you paying to transfer when you could actually just be reducing them instead? Are you paying a high health premium but refusing to exercise? Are you paying for expensive collision insurance but driving recklessly?
Oof, that hits home.
Sometimes the best risk management isn't a policy, it's a behavior change. Are we buying insurance to cover up our own bad habits?
That is a powerful thought to end on. Are we using the safety net as a hammock? That is something to chew on. Well, on that note, we're going to wrap up this deep dive. I hope you look at your next policy renewal with a little more respect for the math, the law, and the philosophy behind it.
It was a pleasure.
Thanks for listening, everyone. Catch you on the next deep dive.